Hello and welcome to today's CID speaker series. I am Lisa Moharjan, Master's in Public Administration and International Development candidate here at the Harvard Kennedy School. I look forward to today's discussion on mobilizing capital markets towards sustainable development. The format for today's session is a 15 to 20 minutes presentation and around 20 minutes for Q&A in the end. Before we get started, I want to mention a few housekeeping items. During the Q&A, you can submit questions directly in the chat or by using the hand raise function. We are also recording today's session and the video of the event will be available on CID's YouTube channel. This is the last speaker series of the semester and we'll be starting up again next semester with exciting lineup of guests. And also please save the date for CID's Global Empowerment Meeting on April 28th and 29th, which will be live streamed to the public. You can watch the live stream located on the main page of CID's YouTube channel. Opening remarks begin at 2 p.m. on April the 28th. Without further ado, I'd like to briefly introduce our speaker for today, Arsalan Mahtafar. Arsalan is the Director of Development Impact at JP Morgan's Development Finance Institution. In this role, Arsalan maintains their DFI methodology, ensuring that it is in line with best practices in the field of development finance, and applies the methodology to banking and market transactions originated and structured by JP Morgan's Corporate and Investment Bank to assess the anticipated development impact. Arsalan joins the team from JP Morgan's Corporate and Investment Strategy team, where he advised senior management on growth and transformation strategies, including strategies and operating model of JP Morgan's DFI. Prior to joining JP Morgan, Arsalan was a manager within McKinsey's economic development practice, where he advised developing country governments on country growth strategies. Arsalan also holds an MPA ID degree from the Harvard Kennedy School and a dual bachelor's in business administration and international politics from UC Berkeley. Thank you very much for joining us today, Arsalan. Over to you.
Thank you so much, Lisa. It's a pleasure to be here. And as was mentioned, I am an MPAID graduate of 2013. And I must say the MPAID has been one of the highlights of my life. So I really hope you all cherish the time that you have with your fellow students and the outstanding Harvard Kennedy School faculty and staff in Cambridge, and you really enjoy this moment. I'll touch on 3 topics in my opening remarks, and as Lisa mentioned, please then do come in with any questions you might have, and I'll be happy to elaborate on any of the points that I mentioned. I'll first talk a little bit about the genesis and history of the JP Morgan DFI. We are the first, and as far as we know, the only private investment bank that has launched a DFI. So we are a bit of a unique construct, and so I'll give a little bit of information about why we exist. I'll then talk about how the JP Morgan DFI fits in the overall landscape of ESG and impact investing, terms I'm sure you've heard a lot about. And then I'll talk a little bit about our ultimate goal of creating sustainable development as a traded asset class to mobilize capital markets towards sustainable development. So the JP Morgan DFI was really born out of a realization that investment banks are already involved in development finance. They help raise capital for building schools and hospitals and infrastructure and renewable energy, often co-financing the same projects that development banks are also financing. But there's 2 fundamental differences. One is that development banks are what are known in the finance industry as buy-side institutions, meaning that they deploy their own capital as loans usually to projects and then hold those on their books until the maturity, versus investment banks, which are known as sell-side intermediaries, where on one hand, our clients are corporates and sovereigns that want to raise capital to finance their activities and projects. And we help them issue financial instruments and then distribute those financial instruments to institutional investors. Those are your asset managers, pensions, insurance companies, sovereign wealth funds, and the like. The second difference is that development banks have in their charter this core mandate of promoting international development. And as a result, they have advanced impact measurement and management systems to ensure that they're delivering on that mandate. So the thesis of the JP Morgan DFI was to use the same methodologies that the leading development banks use, but apply it to a sell-side business model and use it to evaluate the impact that the various securities and financial investment opportunities that we originate and structure, put an impact measurement management regime around that, and then distribute that to institutional investors that have some sort of appetite for impact investing. So an analogy I always use is that if you think about JP Morgan's investment bank as the financial supermarket, where an asset manager would walk in with their cart and pick, an equity or, a bond or, execute a financial derivative. We are opening a development finance aisle in that supermarket, which is stacked with products that have that impact measurement and management regime baked into them. And so if an investor is interested in that type of product, they could come in that aisle, and hopefully with more traffic into that aisle, there'll be more investment flowing to this agenda. So a question we often get is why? Why did JP Morgan launch a DFI? And I think there's three main reasons. One is that the UN Sustainable Development Goals, which, as you all know, is a comprehensive, ambitious agenda to alleviate poverty and inequality and improve health and education and infrastructure, all while also preserving our natural ecosystems and combating climate change, requires a massive amount of investment. The latest estimates that I saw put it at about $5.7 trillion per year. And that's about a 1.7 trillion increase since the pandemic. So the pandemic really increased that number. And that's an investment required every year between now and 2030, which is the target date for achieving the SDGs. And currently there's only about 1.4 trillion going to this agenda. So there's a massive gap to financing this agenda. And the development banks recognize this. And in fact, in 2015, they all got together in Addis Ababa and they issued a joint statement that the development banks need to focus on how they can help mobilize more private sector capital towards the SDGs to help meet that big gap and scale up private sector investment from the billions to the trillions. This is often known in the development literature as the billions to trillions agenda. And so we went to the development banks, and most notably the IFC, they really supported us on establishing the JP Morgan DFI. And we said, instead of just using your physical capital to mobilize the private sector, you can also use your intellectual capital. Let's use your impact measurement and management systems and methodologies and apply it to the structures that we're originating and try to crowd in investment from the institutional investors who have trillions of dollars of assets under management into this agenda. I think the second reason is that we're seeing a real meaningful shift in investor appetite. I mean, going back to that supermarket analogy, the reason you have now in the supermarkets, all these products that are like, organic or fair trade or, have sustainability stickers or whatnot on them is because customers want them. People are caring, and there's, I'm sure, a lot of literature around why. It's, changes in demographics and social consciousness and the like. But we're seeing a similar shift in the investor community where investors care about the impact of their investments and increasingly want more data and metrics around it. I mean, you might have heard of the term ESG investing, and that's maybe the first incarnation of this movement, where it's more of a risk management approach, where investors try to minimize their exposure to investments that have negative, adverse environmental and social and governance risks with various screens that they put and exclusions and so forth. The next incarnation of that is impact investing, and that's when investors try to get more proactive and intentional about the type of impact they actually want to drive. And they put some ex-ante metrics and targets against that. And there's a monitoring and evaluation regime that they put around it to track the progress against those targets. And impact investing maybe, was very niche at its beginning. Typically, especially for emerging markets, been typically, some private equity funds, typically, under $1 billion of asset under management, and they do microfinance lending or finance a social enterprise in an emerging market and so forth. But now what we're seeing is that the big institutional investors that have the trillions of dollars of assets under management are also launching funds that have an impact strategy. And regulation is also helping with that as well. We're seeing, for instance, in the EU, the SFDR Article 9 requirements that are coming out is saying that, investors that want to have funds that are Article 9 aligned need to be able to report more on the impacts of those funds. So that's a meaningful shift, and it's creating demand for us as an institution that caters to that demand. And then the third element, I think, is the whole Paris Climate Accords and the whole climate change agenda. Emerging markets today, they don't, outside of some notable exceptions like India and China, they don't really have a massive carbon footprint today. Most of the emissions are coming from the advanced industrial economies. However, if these countries do not develop sustainably, and if they don't measure and manage the impact of their development and ensure that it's being done environmentally responsibly, it's being done socially inclusively, then we'll never meet the Paris climate agenda, and we won't meet the prerogative of inclusive growth. So the SDGs and the Paris agenda are very interconnected and mutually reinforcing. And as the attention to climate is growing, so is some of that is spilling over to bringing attention to the SDGs. Let me give an example to bring some of that to more life. In November 2020, we were an underwriter for a bond issued by the government of Uzbekistan, and under normal circumstances, this would have been a general budgetary purposes bond, with the coupon, with the maturity. Investors would have bought it just because of the risk of the issuer and the return that would come in exchange. We were mandated as the development finance structuring agent for the government of Uzbekistan, and we worked with them very closely with their Ministry of Finance to understand the programs that the bond will help support and help them disclose a set of quantitative metrics, development impact metrics, that will be associated with that bond, and put ex-ante targets against those metrics. So, how many schools they're going to build, there were health institutions that they were going to build, there were kilometers of roads, kilometers of clean water pipeline, families to provide assistance, for housing and for females for starting businesses. So all of those were outlined and put into a section in the bond prospectus, which we titled Development Impact. And that was really an innovation we brought to the market. There was never a bond with such a section that outlined all of that. And then we supplemented the syndication process. For those that might not be familiar with the process in financial markets, when the government is raising hundreds of millions or billions of dollars, we're not just matchmaking them with one investor. We are marketing that opportunity to hundreds of investors, and one investor might put in 10 million, another would put 20 million, until we build the book to finance that and price that paper. So we supplement the normal reach out, which there still might be investors that are coming in just for the risk and the reward, but we supplement that to additional pockets of investors that do care about the impact and want to know those impact metrics and targets. And the fact that it has that feature is an attractive feature for them. And so it brings in additional liquidity to that instrument that otherwise maybe would not have existed. So, we launched the JP Morgan DFI in January of 2020. And since we launched, There have been billions of dollars of transactions where we served as development finance structuring agents. But the reality is that if we're really serious about meeting the SDGs, it's really not enough, right? JP Morgan, even though we're the largest investment bank in the world, we're still less than 10% of global capital markets. And so that's why our last objective is really to try to scale what we're doing. And the way you scale is by standardizing and replicating. And so our philosophy from the beginning when we developed our methodology was to be open source. We put our methodology in the public domain. You can see it at jpmorgan.com/DFI. And we have been taking feedback from the investor community, from the development finance community, and we've been very open to share it with other capital markets participants. And we want to encourage more banks to help corporates and sovereigns issue instruments that have this development impact measurement and management feature. And we want, hopefully this to set off a virtuous cycle where there's then more asset managers launching funds that target this type of product, because now there's more supply of this type of product in the market. And so all of that could hopefully scale what we're doing from the billions to the trillions and help, help us all move closer to closing that very large SDG gap. Let me pause right there. I see there are some questions coming in, and so let me open it up to questions.
Thank you very much, Arsalan. Super motivating, super inspiring, and also just like very great to see that the DFI methodology has been open sourced. And the goal is not to monopolize, but then to invite more players to enter the market so that we can meet the goal from billion to trillion. And the goal is very clear, to meet the SDG goals. I guess I will get us started with a question that I have of my own. From what I understand is, this is something that JP Morgan pioneered. And I understand that you were part of the group, or perhaps one of the,
Yes.
In the forefront of this. Would like to understand the process of coming up with this idea, and just how did you get started? Where did this all begin? And then we can take questions from the audience. Thank you.
Absolutely. So this all began from one of the senior members of our firm. His name is Daniel Zellico. He came from a development finance background. He used to be an executive vice president at the Inter-American Development Bank. And he came to JP Morgan and headed both the public sector coverage function, as well as the infrastructure finance and advisory function. And so he, as I mentioned, saw that, JP Morgan's already involved in a lot of these programs and these projects that have development impact, and kind of compared and contrasted what we're doing versus the development banks. And so this thesis was developed. I was in the strategy group at JP Morgan at the time. And so given my background in development economics, he came to the strategy team and asked for support to help build out the business case for launching the DFI at JP Morgan. And so I partnered with them to help on this effort. And we presented it to our executive committee, and we got the green light to go ahead and do it. And so he kind of, tasked me to help flesh out the idea. We then signed a memorandum of understanding with the IFC, again, saying that given that their mission is to try to crowd in private investment, we think using their methodology and applying that to our transactions will help that mission. So they, said that they are willing to help. They seconded a person from the IFC to our firm to help us with this task. She introduced us to all of the various people at IFC that are applying this methodology for IFC projects. And we work to then, adapt that methodology for JP Morgan transactions. And there were, tweaks we had to make to it, because there's, first of all, a broader set of products that we have in the investment banks versus the, typically just a loan product that a development bank has. So we had to see how it could be applied to the various, financial instruments that we as an investment bank originate and structure. And we had to make it pragmatic and practical in the speed that capital markets operate. IFC may be doing a lot of these impact assessments over a much longer time and with a larger team. And we need to, do it in a way that is meaningful enough, but can be done at the speed that capital markets operate. So there was some adaptation that was necessary, and we applied and we socialized it with a lot of other development banks and other people in the space to ensure that it is meaningful and credible. And we got very positive feedback, and then we launched the group in 2020, and we brought someone, her name is Faheen Ali Poi, from the IFC to head the team, and she brought me in to help operationalize the team.
Amazing. Thank you, Arsalan. Now, I guess we can go on to the questions from the audience. The first question, if you would like to, Greg, if you would like to ask the question, please feel free to unmute. Otherwise, I can go ahead and read the question too.
Thank you very much, Arsalan, for this very, very comprehensive talk. I have a question. I guess if you want to turn development finance into a traded asset class, you will need data to be able to quantify exactly this risk benefit of each project. And very often what I have noticed is that this data is hard to find. For example, the recovery rates of projects in developing countries. Do you have any data issues as you go into that? I guess you have your own pipeline of projects, but can you partner with other organizations to get this data? Is it a problem? And if it is, are these specific types of data that are harder to get than others?
Gregor, that's a fantastic question. There's two parts. I would answer that in two parts. First is that we are applying this impact measurement and management methodology to a standardized set of existing product formats, such as EM, corporate and sovereign bonds, or EM or corporate sovereign loans, or we can apply it to derivatives, we can apply it to equity issuances. So there's a lot of standardized products that we're putting this impact measurement and management system as an overlay on them. But what that helps with is that there is data on the underlying standardized product that investors can use when they want to measure the risk kind of factors. That said, part of the thesis, of course, of doing this is to scale the volume of both existing products that now report on their impact, but also maybe open up doors for other people who that want to do impactful projects to use this as a vehicle to do that. And there we might get into territory of new issuers or new projects where that underlying data does not exist. And there is something that we have been actually talking to the development finance community. I'm actually based in New York, but I'm in Washington, D.C. This week for the IMF World Bank spring meetings. And we've been speaking to them about how they can maybe share some of their database on the projects that they have financed to help build more information on loss rates and recovery rates and all of the things that you mentioned, for especially when we are maybe working with new clients that don't have that history and don't have that yield curve to for investors to rely on. We can use that database to find comps and to see that data. There is a database known as GEMS. It does have some of this data, but it is not fully accessible and comprehensive as it could be. So that is an ongoing discussion that we're having.
Thank you very much, Arsalan. Really appreciate it.
There's another question for you. Max, would you like to unmute yourself and ask your question directly?
Sure, can you hear me? Thank you. I'm Max Boucher. I work at the Center for Sustainable Development at Brookings in DC. Just a question, Arsalan. To what extent does JP Morgan works with cities and local governments directly? I mean, you mentioned the different challenges related to the SDGs and climate, and obviously local governments will play or already do a key role in addressing these, but their constraints, their capacity, resources are of course very limited. And so my question is, what's your take on capital markets appetite to directly invest in the, for instance, SDG strategies of cities? Thank you very much.
Absolutely. So we have seen some positive momentum in that space. We have served as the development plan structuring agent for the city, for the municipality of Istanbul twice. Most recently, it was just a couple of weeks ago, where they wanted to raise capital for the construction of an expansion of some metro lines to, of course, improve transportation and reduce the amount of car traffic and all of the issues that are associated with that. Reduce some of that burden over the city. So we did help them in issuing Eurobonds and accessing international capital markets to finance those projects. And again, they put, it wasn't just a use of proceed bond in the terms of this is the amount of dollars we're going to spend on the metro project. It was an impact measurement and management bond in the sense that it said, here's how many passengers per direction per hour that we're going to be able to, provide mobility to, on each of these lines. We're going to think about how to monitor and evaluate the impact we're having on air quality. We're going to think about how to monitor and evaluate the impact we have on fatalities due to traffic accidents and so forth. So they're really, employing that impact measurement and management technique on these projects when we work with them to help develop those metrics and put that into that bond prospectus.
Arsalan, we have a ton of questions here. I'd like to request Louis to please unmute yourself and ask your questions.
Hi, good afternoon. Can you hear me?
Yes.
Thank you very much, Arsalan, for your comments. My name is Luís Maia from the Lisbon School of Economics and Management, and I've been doing some work on blended finance. So I'm very interested in hear your comments about also these questions I have. So recent data from the OECD shows that it's been difficult to mobilize private investment for development, despite all this new agenda that we have on blended finance. Can you please comment on that? Do you have any data that might contradict this assessment? My other second question is, to what extent, I know it's a JP Morgan DFI initiative, but to what extent do you see yourself as distinguished from bilateral DFI such as the US DFI, the German DEG, the British now have they changed the name to British Development Investment, the French Park, or even the Dutch FMO? And also the last one is related, in a way, because I'm more interested in the governance elements of this impact investment, blended finance. To what extent you've been following this work by the Publish What You Fund, the DFI Transparency Initiative, and to what extent you are looking at that as a way also for the how you portray yourself in terms of governance? Thank you.
Thanks, Luis. Great question. So on the blended finance front, I agree with you that blended finance has typically been very bespoke, very special situations where blended finance applies. The volume that exists is, it's very small pockets and each have their own eligibility criteria. And so it's needed, it's great. It's very helpful, but its applicability is limited. And so, that's why we're really trying to mainstream development impact measurement and management and bring it to standardized, replicable products. And what we're seeing is that, again, there are situations where you need concessional capital to finance development, but there are many, many other situations where concessional capital is not necessarily needed to finance development. emerging markets generally, we've all studied this in school, right? They're more capital scarce, and as a result, the return to capital in an emerging market is larger than those in developed markets. And even if you risk adjust it, there are many situations where the risk adjusted returns are there. But again, investors are now thinking about, how do I measure and manage the impact of these, and how do I make it applicable for that? And so bringing that transparency and disclosure and regime around it is increasing appetite without necessarily the need for concessional capital. So that said, one of our functions as a development fund structuring agent is we do help the client navigate the products that are available from the official development institutions, including blended finance, guarantees, anchor investments or the like, and try to leverage those whenever they're needed. Which kind of brings me to your second question around, our relationship. The fundamental difference of us and the whether bilateral or multilateral DFIs are, of course, that now the whole sell side versus buy side model, right? They're deploying their own balance sheet. We're originating to distribute, and often we have originated products where we also distributed to the DFIs. There was a transaction in the country of Georgia Railways, to again build clean rail infrastructure, and the EBRD came in as one of the anchor investors into that bond. So there are several ones that we collaborate in that fashion, and I think there's even more and more space for us to look at places where we can collaborate with each other. And then lastly, on your governance point, it's interesting. This whole impact measuring and management that we do is, as mentioned, is what the development banks do, but they often do that assessment for their own purposes. They keep it in their own institutions to measure the impact of their portfolio. They don't publish their impact measurement frameworks and results typically. However, we, on the other hand, when we do that measurement framework, there's the disclosure portion of it that is actually put in the bond prospectus, and that's announced to the market. It becomes a public security, becomes a public disclosure. And then we produce a more detailed report that actually has an impact score on it and everything that we give to the issuer client. And we, again, encourage them to either publish it or give it bilaterally directly to the investors that have invested into the product. So we are in that way encouraging more transparency on the impact measurement regime. We think that's kind of the way of the future.
Awesome. Yurong, would you like to unmute yourself and ask your question? Yurong?
Hello, yeah, can you hear me?
We can.
Okay, perfect. So first of all, thank you for your time. So I have a quick question about the sources of information you and your team consume on a daily basis, because unlike conventional investment news that we can get from Wall Street Journal, so on and so forth. So may I ask, do you have any like books, podcasts, or newspaper that you would recommend for students? Thank you.
Absolutely. So just, in terms of data sources for our analysis, we use the UN stats database on SDG indicators, and we also use the Sustainable Development Solutions Network, which also produces SDG scorecards for every country. And it goes down to the target level of, under the 17 goals, there's 169 targets, and it goes one by one and shows whether, how a country is on each of those targets, whether they're above or below their thresholds, and what is the development gap they have against each of those various targets, which is a core feature, of course, of our analysis. In terms of broader, sources of information, one that I really like it's called Project Syndicate. It's one where actually a lot of HKS faculties often write articles in, but it's generally academics and practitioners that write analysis in that on that platform. And then I also typically read The Economist and the Financial Times as authoritative kind of media in this space. And the Financial Times in particular has a column known as Moral Money, which they talk about this broader topic of any sort of capital with purpose, which is the space that we're operating in.
Thank you very much.
Alicia, would you like to read your question?
Hi, can you hear me?
Yes.
Okay, great. Thanks so much. So my question, I guess, is more of a, not so much how do you think about the risks in terms of what you should finance, but the bigger bird's eye view of if you think you're trying to promote sustainability in a way that's going from billions to trillions of dollars of investing, how do you think about what are the right goals for sustainable development? And then more importantly, how to measure and track those across time? Because once the money starts to get that big, really having that bird's eye view matters. And you mentioned the SDGs, you mentioned the Paris Agreement. Those are great goals in some ways because one really focuses on intergenerational well-being, the SDGs, equitable development today, and Paris thinks about the future, more future generations. But neither set of them is particularly effective for thinking about trade-offs. Of course, there's a bunch of other approaches developed by academics, from HDI to happiness to inclusive wealth. So just curious how you and the people you work with think about the goal setting challenge and then the measurement and tracking progress against those goals challenge.
Yeah, no, that's a good question. So, when we thought about launching this, we really wanted to leverage what is already existing and not reinvent the proverbial wheel. So we really anchored it into the SDGs. The SDGs are comprehensive, they're significant, they have the significance that all UN member states have signed up to them. So there's consensus behind it. And they really touch on all dimensions of human well-being. So we really look at first, what are the gaps to the SDGs? I was looking at something interesting. If someone is, raising capital to finance building a school in China, everyone would think, okay, that makes sense. That's a great thing, and it is, but it wouldn't qualify for our sustainable development label that we're putting, on transactions, because China has already met its targets under SDG 4 for quality education. So that would still be like a social bond, or because it has a social mission and so forth, but it wouldn't be development because there's no development gap. So measuring the gap and then the contribution towards bridging the gap is kind of core to our methodology and what we do. Also, there's other things we look at, what we call cross-cutting criteria, which is always the impact on the environment, on jobs, on gender, on governance, whether something's denominated in local currency or not. There's a variety of factors we look at, and those factors that we're looking at and all come from the methodology, which again came from IFC. So again, rather than reinventing this, development banks have been doing this for decades in emerging markets. Let's leverage already the criteria and frameworks that they're using rather than necessarily reinventing it ourselves. So the SDGs, our development impact framework that came from IFC, those are the two anchors in the criteria that we use for our analysis.
Arsalan, there are a lot more questions. I'm going to read one of them. We are running out of time, so maybe this will be the last question. And if you don't mind, maybe we could share the email with participants and they can reach out to you directly.
Absolutely, please.
Awesome. So the last question from Sanya, given the current trends, when do you expect that the entire global financial system could shift its current financing structures from profit to social and environmental purpose-driven purposes? Is it even possible to scale this systematically given the current incentive structures?
So I don't think that that shift is necessarily the shift that that we're seeking. It's not for me an either or, it's more of an and, right? It's more that are there additional factors that you put into consideration when you are an investor, right? Obviously, returns are important as an investor, and there always will be. And there will always be, as you know, institutional investors are also investing the retirement money of you and I. And as to the day that you and I care about, you know, our retirement fund to grow, institutional investors that manage those funds are going to care about returns on the investment. So that's always going to be a factor. But the more that you and I all care about other dimensions in addition to the growth of our retirement funds, such as the impact that those funds have on society, the more those investment funds will therefore also care about that and seek products that measure and manage their impact, and will move in that direction. So I really truly believe it is a bit of a bottoms up shift, that as more social consciousness expands and people really care about this and are willing to not just pay lip service to it, but live their values and put their, you know, money behind it, the more that there will be demand for such products.
Awesome. Since we're running out of time, I think let's close here. Thank you again, Arsalan, so much for such an insightful presentation. I surely learned a lot. Thank you for opening up the new aisle and, you know, opening it up not just at, you know, JP Morgan, but creating a way for others to join the bandwagon, I guess. Thank you very much. I'd like to remind everyone again that CID's Global Empowerment Meeting is going to be next weekend, April 28th and 29th, which will be live streamed to the public. You can watch the live streams on the CID's YouTube channel, and that begins at 2 p.m. on the 28th of April, and we hope that you'll join us there. Thank you again very much. Thank you again, Arsalan. It's really wonderful to see you. Thank you.
Thank you for having me.